Have you ever heard that old adage, never step in front of the subway crowd? Well, in spec trading, it's true. If you're bullish, you need to get in and then have a wave of buyers come in behind you and bid the market up. Then you have something to sell into. You never want to be the last buyer at the top. In fact, you want to be selling to that guy buying at the top, right? You need to be able to get out of that position and monetize it. So you have to ask yourself, where's the next buyer going to come from? And I think that's the situation we're in now in oil. But let's talk about it this week in oil. Hey, I'm Aaron with the Oil Balance, with 30 years of experience in trading and analytics in the oil market, and I'm here to elevate your understanding of the oil markets. All right, let's kick it off this week with a view of the weekly crude chart like we do so many times on this channel. Again, I want to point out to you that we had another down week, again for the second week in a row like last week. We had only one up day during the week, 4 down days, and again Friday had the lowest settle, not necessarily the lowest low on the week, but the lowest settle of the week to make these markets look quite heavy. As you can see from the Fibonacci retracement I have outlined here, from the very low mark here to the highest point of the Israel-Iran conflict, we've retraced almost exactly that 61.8% retracement. You could also lay a Bollinger Band on here, and you'd see that this week we sort of settled right at the end of the week, right on that midline, meaning we're sort of at a inflection point. If next week we go below that midline of the Bollinger Band, that likely signals more selling coming into the market. If we can stay above it, maybe you kind of go sideways for a while. But like I said, you've got to figure out where the next buyer is going to come from. So there's a couple things extrinsic to the market that we'll talk about here in a minute that maybe could get the bulls excited again and bring them back in the market. But when you talk about just oil fundamentals, I don't know, things are cooling off a little bit. Let's just say that. So that's the crude oil market here. It definitely seems sort of soft or bearish or heavy. If we look at the heat crack market, heating oil has actually been doing a little bit better. Again, this is a weekly chart, and you can see we've had a decent rally over the past few weeks. It seems to be maybe stalling out here a little bit towards the end of this week. But again, inventories are really low. Gasoline inventories are pretty much middle of the range right now. They're not too exciting. Demand for both gasoline and diesel has been a little bit soft here the last couple of weeks. It's possible, even though it's the end of July, beginning of August, the market's already starting to take its focus away from driving season and maybe look a little bit more forward down the road to heating season. And maybe that's why we're getting a little bit of a bid here. You can see in previous years, like 2023, we had a huge rally this time of year. In 2022 is a little bit more complicated. We had a lot of volatility in there from Russia, Ukraine, and trying to rebalance, trying to figure out where Europe was going to get that 1,000,000 barrels per day of gas oil that it was previously getting from Russia and sort of self-sanctioned at that time once Russia invaded Ukraine. So by those two scales from 22 and 23, this year's rally actually seems kind of small. I mean, it's a good trade if you're in it, but it does seem a little bit small. And again, we're maybe starting to tip over a little bit here and see the top. Another crazy indication this past week was the crude spread. So Augie SEP went off the board. Of course, the August contract went off the board this past week. I like to look at the penultimate or the day before settlement for evaluating the spreads, simply because you have two different times for expiration on last trading day. As you probably know, the front month on last trading day has a 30-minute window, while all the other contracts, like a normal day, would have a 2-minute closing window. So it's a little bit apples and oranges trying to figure out where that spread went on actual last trading day. So that's why I like to look at penultimate day here. But the point is, even though we had inventories at the lowest utilization level for Augie SEP going back as long as I have records, which goes back to 2011. So again, utilization, you need to figure out what your total working capacity is for storage and divide that by the current inventory that the DOE puts out. At any rate, we're at that lowest point we've ever been for Augie SEP going back to 2011. Meanwhile, if you see where the spread went out at about 119 on that penultimate day, it wasn't quite as strong as it was a year ago, and not nearly as strong as it was in 2022. When again, we were dealing with a lot of the Russia-Ukraine stuff, and there's a lot of fluff in the market, a lot of risk premium put into the market as the market was trying to figure out what was going on with Russia, Ukraine, and what that really meant for the rest of the oil markets. So that's another sort of signal that you would think the market would be stronger than it is, giving us a little bit of softness. Not a lot. I mean, 119 is still a fairly robust spread to go out, but at the same time, you would think that we're at the lowest levels we've been for Augie Sep. Maybe that spread would go out a little bit stronger. So again, I think there's a bunch of evidence we're trying to look at to try to determine where the market's going to go next. So crude oil production this week actually crossed below year-ago levels. So that's the first time all year that we've seen the crude production number as posted on the weekly data from the EIA going below year-ago levels. So there's a couple things going on here with this number. First of all, it's not as much a weekly survey as it is the DOE taking, or the EIA taking, the monthly 914 survey, and then an internal model that they have to try to model out what production must be doing on a weekly basis, and coming at it from that standpoint. So it's not like a survey like they do with inventory, where every single week they're asking the market, well, what's your inventory here? What's your inventory there? That sort of thing. It's more of a combination of an algorithm that they have worked out plus survey data that is asking for data that's fairly old at this point. In other words, we just sort of proved out the numbers for April. Here in the next week, we're going to get the May numbers coming up at the very end of July here. So again, it does show production going lower, going below year-ago type levels, but it might not be the most robust way of looking at what production is doing. As you probably know, in the weekly numbers, you also have an adjustment number and you have a transfer number. So the oil market, especially in Texas, is transferring NGLs, mostly in the form of condensate or natural gasoline, and they're stuffing some of that into the crude barrel as it goes out into the pipeline system to be exported or to go to local refining demand, whatever it may be. So there's that weekly number that they give us. It's not included in this stat you see here on your screen. And then there's also a weekly adjustment number where, again, they take the change in inventory as reported to them from the various surveys that they do, and that would give you one number of what the implied change was on the supply and demand balance for that week. And then they take the individual variables for that supply and demand, and to make those two things bridge, to make them come up to the right number, because they don't always necessarily come up to the same number, they adjust the production number, or they make an adjustment to the supply side of the equation, if you will. It doesn't have to be production. They make that adjustment to make the variables add up to what the change in inventory does. So that adjustment number can be winging around quite a bit. I believe this past week, it showed a week-on-week increase of 900,000 barrels per day. So that's an amazing swing. It's been, actually, we've seen week-on-week changes of bigger magnitude than that. But so just keep in mind there are other methods for showing supply than just looking at this production number, but the number is given, the chart as you see it here is what it is. You would think that would be fairly bullish for the market to see inventory slipping below year-ago levels. So actually, year to date, when you start looking at these numbers, depending on which way you measure it, we're up around 300,000 barrels per day versus last year. Again, if you look at it once you've added in all those adjustment factors I just talked about, or if you look at just these numbers here on the screen, because back in March and April, we had this time period where production really was, pretty significant above year-ago levels. And it's kind of slowly deteriorated here in the last couple of weeks down towards the year-ago type levels. So again, as I hinted before, we saw a ton of hedging going through in June on the back of the whole Israel-Iran conflict. Some of that hedging could be for new production, which again, so you're thinking 3 to 6 months out from that event. So September, October, November, sometime in there, we could see a decent increase in production again, just based off of that one big spike in price. It could just be that producers have increased their hedge levels and now they're a little bit more resilient if prices should go way down, meaning, into the 50s or into the 40s. They could be more resilient in terms of keeping production somewhat steady, if not guiding a little bit lower, because they've got the hedges on, or they've got better hedging production than they did previously to June when Iran Israel really kicked off. So there's a couple of different ways of looking at it here, but again, just looking at the data that we have, the chart in front of us, you would think that that would be somewhat bullish. Lastly, on the retail price level, some interesting things going on. As you can see, diesel prices popped up about 5 weeks ago, right up to year ago type levels. Inventories have been tight. We've been talking about that for the past couple of weeks on this channel. Prices are right at year ago type levels right now for diesel. So again, by itself, it's maybe not super bullish, but you wouldn't really think it would be bearish. The funny thing is, though, you've got relatively high prices. If you look at the price we're seeing now versus what we've seen the rest of the year, we're sort of on the high end of that range. Yet demand is, on the weekly numbers anyway, looking a little bit soft here the last couple of weeks. And then gasoline has just been really flat. I mean, you're seeing a small change week on week in retail gasoline prices, but overall, the variability of prices over this past year has been pretty minimal, especially when you look at last year, we had much more seasonality sort of built into it. So from the pump price, you're already getting a little bit of demand softness coming in. Maybe these higher prices will slow down a little bit of demand as well. I kind of doubt it. You usually need to see much higher increase year on year in the retail price to really affect demand. But I am a little bit puzzled that you are seeing prices go up and demand go down at the same time. That's again not necessarily the healthiest thing to see in the market. So those are sort of the things I wanted to cover this week in terms of the charts. Another maybe thing to consider, given that the basis markets are so weak, especially in crude oil, they're weaker than you would think they would be given inventory so low, and then the spreads that we mentioned going out really relatively soft, especially again given inventories. That's sort of giving us some mixed signals, right? So again, the low inventories would make you think it's bullish, but we've had low inventories for quite a while now. It's not a big surprise to the market. People are kind of used to seeing these lower inventories. And now that we're getting not only lower futures prices, but lower basis markets on top of that, so the regional markets are trading soft as well as the big futures market, that's not a very strong signal either. OPEC is set to meet, I believe, on Monday, the JMMC meeting. So sort of the meeting before the meeting where they really talk about, it's more a meeting about what supply and demand is doing, how these things are sort of fleshing out. It's called the Joint Ministerial Monitoring Committee. Before the bigger meeting, or maybe the more important meeting on the 3rd of August, which is when OPEC Plus meets together. Again, OPEC Plus is widely expected to do another 550,000 barrel per day increase for the month of September, which would bring them back. So remember, OPEC Plus took 2.2 million barrels off the market, but they've had a series of increases in production this year. And if they do this last one for September, that would bring the entire 2.2 million they took off the market. That would bring it right back to parity. So they took off 2.2 and then they brought it all back this summer, which is quite amazing. So again, there's different ways of trying to interpret that information that I just gave you. We know there's some very good sources saying there's cheating going on. And I tend to sort of side with that. And so I maybe present it maybe a little bit stronger than others would. But anyway, my bias is that there's a lot of cheating going on, and that part of what's going on with these OPEC Plus increases is just sort of justifying that overproduction, and sort of because they're sort of slowly losing control of keeping everybody tamped down, especially like Kazakhstan, just for instance. The other way of looking at it, or maybe not necessarily the other way, they're not necessarily opposed to each other, but another lens you could look at it through is there is more production than what they're letting on, either because they've been increasing production all this summer through these meetings, or there's been overproduction. But by and large, the market is able to absorb those barrels. So demand must be better on a global basis. And that's, I guess, more of a bullish way of looking at the information, looking what's going on. The problem is whether you look at it from the fact that everything's okay because so far we've had the demand to absorb it, or they're actually just trying to justify overproduction. Very quickly here, we're coming to a time of the year where demand just starts to fall apart. Now, from like a US perspective, which drives a lot of demand in the northern hemisphere, right? You have the end of summer, you have kids going back to school, you have people sort of settling back into their jobs in the fall. You have a little bit of time of transition in the shoulder months there where it's not really cold enough for heating demand just yet. You have from a crude oil perspective by itself, you have a lot of refinery maintenance going on. So demand just starts to kind of cool off naturally starting in September. So it's a little interesting to me, and I've said this before, but I'm going to say it again. It's concerning to me that OPEC thinks that they can raise production by another 550,000 barrels per day into September and just kind of stand back and see how things go. That to me seems pretty bearish. And maybe that's what the market's starting to price in. Maybe that's why it's so hard to find the next buyer in this market right now. People are just taking a step back and seeing what's going on with OPEC and what's going to be the next steps. Now, I said the market is widely expecting OPEC Plus to come out and increase by 550. They don't have to. They could come in with a lower number. They could keep stuff flat, and that would probably be fairly bullish just from the shock of, well, we're not getting as much increase as we thought we would. I think if you think through it, maybe that's actually a more bearish sign because maybe the demand's not there on the other side. So again, we'll see how the statements are worded. We'll see what they actually come out with and what kind of caveats they put around it. Previously on these OPEC meetings, they've come out pretty quickly and said, look, we're going to be watching markets closely. If there's an imbalance, we'll take barrels off the market. And I think that's where they're going to have a hard time. If OPEC Plus comes to the point where they feel the market's oversupplied and they have to take barrels off the market, everyone's got to turn around and look at Saudi Arabia and be like, okay, Saudi, you do that, because that's been their typical role. Are they going to be there to do that again? I don't know. That's where it gets interesting. And that's where the market could start to fall apart in terms of, forget all this talk about bullishness. Let's flip over just to be sort of a solid, bearish outlook now in the market if the demand's really not there for OPEC to increase production into. So a couple other things too going on. And we discussed retail prices on the diesel side are relatively high, but demand's low. We just discussed that a minute ago. RINs are getting expensive. So without going into too much detail, it's sort of a complicated thing. Again, if you like this presentation, if you like this sort of thing, please hit like and subscribe. If you want more details about this stuff, please go to our website, theoilbalance.com, and there's a button that says add me to your distribution list. I go into much more detail in that written part of the report about what RINs are, what the RVO is, and why there's some interesting signals that we can get from this statement that RINs are getting expensive. But for the time being, for the purposes of this video right here, let's just suffice to say expensive RINs are like a cost, an added cost to the refiner. They're an added benefit to the companies making renewable fuels. Okay, so maybe we'll just leave it at that. It does put the petroleum refiners in a little bit of a harder spot in that it just makes it that much more expensive for them to do what they do and turn crude oil into usable product. Margins are fairly good. Don't cry for them. It just makes it a little bit harder from a pricing perspective. That's all. And of course, we always have geopolitical risk. We always have the weather risk. There was a storm that that NOAA was watching in the Gulf Coast. It was a very low probability. I think it actually disappeared from the map today, right in the Gulf Coast. But it is the season. We need to keep a close eye on the Gulf, on any tropical storms that could shut in production or, worst case, do damage from an oil perspective, worst case is you do damage to a refinery because that takes much longer to bring back to market. The producers in the Gulf are usually pretty good about shutting in production ahead of time and then being able to start it up quickly. Again, by and large, it's not always the case, but that's typically how things work out. They're a little more proactive on the production side than you can be on the refining side. So that being said, it seems to me that there's a lot of bullish things in the market, but they're not new bullish things in the market. They're sort of old bullish things in the market that everyone's seen, everyone's had time to digest. And now we're looking around at each other as prices have come off again, saying who's going to be the next buyer? Who's going to step in and buy this thing? And with the information we have thus far, maybe it's a little bit hard for me to see where that's coming from. So I'll be very interested to see what happens with this OPEC Plus meeting, what they say. If they do bring production back, then that kind of kicks the ball down the road a little bit, if you will, kicks the can down the road a little bit. In that I want to see what happens once demand actually does seasonally drop off and how OPEC handles that and what that situation is. So I guess the good news is inventories are low. We do need to replenish them. Maybe that's a good time to replenish inventories, especially here in the US on everything. But so I hope that clears that up. We're definitely shifting to a more neutral stance on the markets for right now, especially for this next week. And we'll see what happens on the technicals on that Bollinger Band, as we mentioned. We'll see what OPEC says. Again, on Monday, the JMMC is going to meet. We'll probably get headlines around that. And then on the 3rd, which is a Sunday, OPEC Plus is supposed to meet. But as you know, they're usually meeting on the Saturday. So we're getting some sort of information Friday or Saturday before that meeting that usually ends up, either being the actual result of the meeting or a very good indication of what's going to happen. So stay tuned for that. And that's all I have for now. Again, please like and subscribe. And please go to our website, theoilbalance.com. And again, hit that button that says add me to your distribution list. You can send me questions or anything else like that, especially if you want to know, if you do want me to go into detail about the RINs market and RVOs and all those kind of fun things. So that's all for today, and we'll talk to you later. Bye.